Sometimes all you can do is put one foot in front of the other. And if that's all you can do, then do that. And people always say you should learn from your mistakes, but I tell you, it's a hell of a lot cheaper to learn from someone else's. It will go wrong. You know, we've all been to those network meetings where someone stands up and says, I started doing property, nothing has ever gone wrong. Either they're lying, to put it in, absolutely bluntly, or they haven't been in it for long enough. You know, quite frankly, I feel more like a juggler than a property investor sometimes, I think, or a plate spinner. I think you've got to be relentless. I think you've got to be consistent. I think it's being in charge of your own destiny, your own time. And, you know, that brings with it, you know, an awful lot of cons as well as pros. You know, hindsight is a wonderful thing. We probably grew too fast, leveraged too much. You know, nobody ever went bust banking a profit. I've given some talks about resilience, and I've looked at sort of dictionary definitions of resilience and things like that, and I don't think they quite get it. And I encapsulate it into winners find a way.
Hi everybody, and welcome to another episode of Property People. Today I am joined by Mr. Jason Living. How are you today, Jason?
Yeah, very good, very good. Delighted to be here.
Good. Great surname, by the way, actually, for being in property.
Yes, yeah, it has often been mentioned.
Yes, you have a middle name, Love Living. That's
Maybe I should do. Yeah, it's funny because I've never made use of it for about, if you like, in terms of naming a business. Our business is called Argyle Square Properties because that happens to be where we bought a number of properties. So I've never made use of the sort of living.
Yeah, I think it might be missing a trick, but I'm no marketeer,
Maybe.
So don't quote me on that. But Jason, you're a chartered surveyor and very experienced property investment professional. You've been doing it for over 30 years.
Indeed.
You're the founder and managing director of, as you say, Argyle Square Property Group, which owns and manages a diverse range of residential, commercial property assets. Nearly 170 properties.
That's right.
With a value of over £15 million. Also operating the short-term rental business, which I'm very interested in these days.
Yep.
Across Sunderland, catering for contractors, leisure visitors, and helped over 1,000 other property investors do similar things to what you're doing through training and masterminds, etc. It's a pleasure to have you with us today. I think you're going to have a lot of insight, which will be helpful to a lot of people out there who want to do something similar, and go through the highs and lows that you've already been through. So before we go into that stuff, I wanted to ask where it all started, and more specifically, what type of person you were at school. Were you academic? Were you studious?
I think yes to the first, in the sense that I think I always did reasonably well at school, but quite a big no to the second. I don't think I was a particularly diligent student. I think if I'm brutally honest about it, I think I didn't achieve the grades and things that I could have done. And in fact, whilst looking at A levels, I passed them. A couple of them was work with sort of slightly lower than expected grades, and I did an extra sort of term and retook those and got much better grades at the end. So, studious probably not, but I had a reasonable level of ability.
And did you go to university?
Yes, yeah. So I had a year out, not purely to do those retakes, although that was part of it, and then went to Reading University and studied land management, which is essentially surveying, basically. So that was my sort of lead into the chartered surveying side of things.
And your family background led you to want to study something like land. What was it called?
Land management.
Land management.
I mean, which is, there's various places call it land economy or various things. I mean, essentially, it's what you go and do if you want to be a surveyor.
Yeah.
I think land management in a way is I think a slightly confusing title, but if you take it in its literal and general sense, it is the overall wider management of land and everything on it. I suppose so. Property.
So, having studied that, what was your first job that you in your career?
Yeah, so I specialised in my third year in planning and development because I felt that was a more sort of entrepreneurial route than what is generally termed general practice surveying, which is doing rent reviews and valuations and that sort of stuff. So I specialised in planning and development, and then when I left, I got a job with a firm called GL Hearn, based in Borough High Street, just near London Bridge, just south of the city. Doing planning consultancy. So for a number of years, I was a commercial planning consultant, and they were a great firm to work for because they had a fantastic client list, Used to do a lot of planning work for sort of Tesco and other food retailers, but particularly Tesco. And it was in the heyday of them getting their sort of out of town, out of centre stores, which typically were not always favoured by the local planning authorities, who ended up going to appeal and going to big inquiries. So it was great being involved in some quite high level stuff with top planning barristers in the country and that sort of thing. So yeah, it was an enjoyable time.
And when you're doing all of that, and in London, obviously, there's the movers and shakers of the property world, doing all these high-end stuff, and working with barristers. Did you have an idea? Did you have a vision for where your property career was going to go, or were you just kind of going from one thing to the next? You'd been influenced as a kid through your family, and you were just, or was there some sort of drive in the back of your mind that that's where I want to get to?
So no, I wouldn't have thought I don't think there was any sort of specific sort of plan or goal. I just always felt that I didn't want to be employed by somebody else for an extended period of time, and I think I always looked at investment property because that's long-term rental income, so that at some point becomes a potential salary replacement. So you exist on that. But also always having one eye on development, because that was always the sort of exciting, sort of sexy stuff, really. So yeah, and looking back, I did have a couple of interviews with more development orientated businesses, and I think perhaps with hindsight that was something I could have sort of pushed towards perhaps more, but that didn't happen in that way at that time.
Do you? In terms of your aspiration now, in terms of development, do you think that those that experience with those barristers, etc., really helped you become a better investor developer?
I think it gave me. I think it taught me to be sort of analytical and really dig into the details of things in terms of due diligence, in terms of looking at whether it's an investment property or development proposal. Not to, it's all too easy, and I think entrepreneurs would perhaps sometimes not detail people, and it's easy sometimes to sort of slightly live by the seat of your pants. So having a sort of a grounding in an environment, a planning environment, where it's all about detail and research and really understanding something, albeit from a slightly different angle in terms of planning, but it was a good grounding, to have that analytical background.
And so making kind of data driven decisions. What year were we talking about when you kind of had this?
Yeah, so it was early '90s when I was in London working for GL Hearn, and then I moved up north, shall we say,
Yes.
in 1996. Yeah, and that, I guess it was after that. So by that time, I had one property in London, which was a property I'd bought with a university friend of mine that we had initially lived in, and then he moved to Somerset, and I moved in London at that time, and we kept that as a rental property, and indeed still own that today. At some point, I bought him out, so that's just one of our portfolio now, and as I say, still have it today.
And so why? So you were originally from Essex.
Yeah.
Moved to London Bridge Way, Borough Market, for work, and then ended up in the north.
Yes. Yeah. So I met my wife in London. At the time, she was nannying for a family who lived sort of between London and North Yorkshire. And at that time, their youngest daughter was coming to sort of proper school age, and they wanted her to go to school in Yorkshire. So they, as a family, were going to be more permanently based in Yorkshire, and offered my wife the opportunity to move with them. And at that time, I think work-wise, I felt I was perhaps in a little bit of a rut. And as I mentioned, perhaps with hindsight, I might have looked to further my career in other directions. And so I think I was a bit frustrated at that point. And I saw that as an opportunity. And in fact, GL Hearn, who I worked for, had an office in Sunderland, which was sort of commutable distance from North Yorkshire. I did look at other opportunities, other job opportunities up there. But when, for whatever reason, they didn't fall into place, I effectively sort of engineered myself a move within GL Hearn to move from London to their Sunderland office.
And you mentioned that you just didn't want to be employed and you wanted to replace it with the rental income. What was it? What is it about being employed that you didn't really like the idea of?
I think it's being in charge of your own destiny, your own time, and that brings with it some an awful lot of cons as well as pros. But I went full time into property in about 2000 when our oldest child was 3, and I've been that's been my full time occupation ever since. And it's things like I don't think I've ever missed a nativity play or a school play or a sports match. I've often been on the touchline of a sports pitch on 3 o'clock on a Wednesday afternoon and been the only parent there.
Right.
That then means you maybe got to work the evening, or you've got to work a bit at the weekend, or you've got to get up earlier, or you've. I don't think self-employed certainly isn't about working less.
Yes.
But it's about having that control of your own time and destiny, I think. And that's always been what I wanted to do.
I think that there is the misconception where working for yourself is not working as much and having the days off. You can have the day, on the golf course and this, that, and the other. When in reality, actually, it's just a bit more of a freedom of choice of your time. But because you're taking on so much more responsibility, you're actually probably working more hours than anybody else in many cases, especially if you want to ensure that success. Because if you don't put in the hours, then nobody's going to be doing it for you, and the food won't arrive on the plate.
Absolutely, and certainly that's true in the sort of initial years. If hopefully you have a degree of success in business, then that may start to free up your time as things progress. But certainly initially, I would say, if you're working for yourself, firstly, you end up working more hours. And secondly, even when you're not working, it's extremely difficult to switch off. It's not like having a 9 to 5 job where, you shut the office door at 5 o'clock and then, your time and your mind are your own. Certainly in my experience, running your own show doesn't work like that.
Absolutely. But you've made it work, and fast forward, you've amassed over 170 properties. How, can anybody do that in a lifetime?
So I guess we started buying. So when I arrived in Sunderland in 96, I think we started buying up there in 1997. And a lot of the early properties we bought were multi-unit freehold blocks, small. So they were typically 3-story sort of Victorian townhouses, I guess you'd call them, that had already been converted into flats. We've completely revamped some of them along the way, but they were already in multi-units. And I guess what enabled us to scale quite quickly was sort of into the probably not initially, but once we got going into the early 2000s, there was significant capital growth, which enabled us to sort of refinance along the way and have sort of credit facilities based on the equity we got in existing properties. And so we were able to buy more. And looking back at that time, increasingly through the early mid-2000s, finance was very freely available. And the banks were sort of throwing money at people, which, lo and behold, is why a number of them went bust, or effectively not that long afterwards. So we had a massive period of growth through the 2000s. Again, hindsight is a wonderful thing. We probably grew too fast, leveraged too much. And, if I had my time again, I'd certainly perhaps do things slightly differently. Perhaps probably sell more as we went along. Nobody ever went bust banking a profit.
Yeah, absolutely. Did you get caught out in 2008 by anything?
So we did to a significant extent, in the sense that, we were effectively just able to refinance as we went along and buy properties and finance those at purchase price when we bought them below market value. So you were sort of continually sort of pulling capital in from various streams, and that was effectively bankrolling the business rather than being bankrolled by true profit income. And so when 2008 came along and the funding line sort of dried up, it was a very difficult period for us. And when interest rates were still high, we think it's high at the moment, with base rate currently at 4.25%. I mean, it peaked at that time at 5.75%. So we were paying that and probably a margin on some of the borrowings. And we amassed or accrued quite a lot of arrears, and then had a battle with some of our financiers, but managed to hang on to everything. And then obviously interest rates, I think it was back end of 2008 through to March 2009, came all the way down to 0.25%, and that enabled us to get positive cash flow and pay back all those arrears and get back on a pretty sound footing at that time.
Yeah, that was definitely a saving grace. That definitely helped me and my family whilst we had a bunch of loans. That interest rate dropping and being on lifetime tracker mortgages certainly saved the day. Um, Stress. How do you deal with stress in times like that?
Yeah, so if I sort of roll you forward, because unfortunately the sort of the peak in interest rates, the arrears and paying those off wasn't the sort of end of our troubles.
Oh, wow.
Because a chunk of our debt, about half of it indeed, was with Northern Rock. They now still manage it, albeit it's been sold off to a hedge fund. And so sort of 5 years into that period, so 2012, so a bit earlier in 2012, they contacted us and said, look, we want to revalue your portfolio. And at that time, it was far more driven by their business, which essentially was by then government owned.
Yeah.
Northern Rock went bust, Bradford and Bingley went bust. They merged the whole lot under a holding company called UK Asset Realisation. And they were busy working out sort of what they got and how to deal with it. So as part of that, they said, right, we want the revaluation of the portfolio, which of course is at our cost as the borrower. Thank you very much. So we spent a vast sum of money having all these properties revalued, and then they came to us and said, well, you're in breach of your loan to value covenants. And that was the only thing we were in breach of, in the sense that we had arrears with them, but they'd all been paid off. I think our arrears with Northern Rock at some time were around £100,000. That had all been cleared some months before. So, we thought we were, and at that time, we got to a position where we had about £10,000 a month positive cash flow, but we had a number of properties that were empty and needed quite a lot of money spent on, so we're not in a lettable condition. So we got to that point. We had a plan to do those over probably a 15 to 18 month period, £10,000 a month cash flow to fund those refurbs. And then, to be honest, pretty much out of the blue, despite obviously we knew that the properties had been revalued, but they wrote to us basically saying, you're in breach of your loan to value covenants and we demand immediate repayment of a sum that was around £6 million. And so I phoned the guy up the next day after I'd received this letter, and I said to him, you'll not be terribly surprised to find we don't actually have sort of £6 million kicking around anywhere to repay these loans. So it seems to me it might be sensible to meet and understand one another's position and appreciate there's a problem, but we need to find a solution and a way to move forward. And the guy said, unless you've got a very large chunk of money to reduce your loans down to beneath the LTV threshold, which I think was 80%, and I think we were on their valuations, which are very difficult to dispute. I think we were slightly over 100%. Unless you've got that chunk of money, there's nothing to discuss, which I thought was a pretty
harsh,
pretty shabby way of doing things. But and every banker I've spoken to about this story, just was amazed that a lender would ever take action purely on loan to value, without trying to have a sort of a workout. And a week later, despite the fact I sort of emailed this guy and I tried to pull together a solution to say, look, if you basically fire sale these properties, you're going to be way underwater on these.
Money, yeah, exactly.
There might be other options. Look, if we can refinance some of them and sell some of them, and trying every which way I could to try and find a more palatable solution. Because quite frankly, the inevitable would have been that they'd have just fire saled those properties, chucked them in an auction. We had a lot in one area, which obviously would depress the price at that point. And, we probably would have gone bust because there were, the limited company didn't actually have PGs on. There were cross guarantees from the personal loan properties, but there was quite a chunk that was personal loan. And then a week later, I got a letter from them saying we've appointed LPA receivers across all that portfolio. But and you talk about stress and how to deal with it. I think, and I've done a few talks on these to various business groups recently about resilience. And the only way I can put it is sometimes all you can do is put one foot in front of the other. And if that's all you can do, then do that. Because at least you're doing something and you're moving forward. I've found when you're in that really difficult situation, and I was in a situation where I just had half of our portfolio put into LPA receivership, and in my experience and most others' experience, that there's not a lot you can do about that. But you've got to find a way forward. And you can't think too far ahead. You can't think, right, okay, if this doesn't work out in my favor, then this is going to happen, this is going to happen, this is going to happen. And ultimately, I'm going to go bust, because, that's not a good place to be, either to be or to even think about being. So I when I'm in those really stressful situations, I can only think short term, and I think that's what you need to do. Because if you overthink it and think too far in the head, you put yourself off. So I got in the car at Darlington Station, having got off the train from London, and I'd had a couple of chats with guys who I knew, were in my network, who had a company called UMove, who were a lettings management agency. They've sort of evolved into a bigger estate agency, and indeed sold out. At that time, they traded as National Property Group. And I knew from speaking to these two guys that they were managing a couple of portfolios for Bradford and Bingley Mortgage Express, which was under the UCAR umbrella, where there'd been distress for some reason. I think one were a couple where one of the couple had died. So normally the properties would have to be sold, but they were underwater, so they were managing those. And there was another portfolio they were managing for some reason, effectively not as receivers, but as, if you like, almost as quasi-receivers. So they were there technically on behalf of the owners of those portfolios, but with full oversight by the lender. So the lender had full transparency. Any surplus monies the lender were using to pay down the debt. So I thought, is this a route out for me? So I got hold of these guys on the phone and said, look, this, and I'd spoken to them over the previous week about what was happening. I said, look, they've now put in receivership. I said, this guy I just can't engage with him. He won't speak to me to discuss it. He won't meet with me. But I've got you on the phone. What I'm going to do is I'm going to dial him into a conference call without telling him that's what I'm doing. And so I phoned him up and I said, look, I got your email yesterday, obviously very disappointed. I really think, we need to work together on this to find a way forward, because, just putting it in receivership doesn't suit you, doesn't suit me. And I've actually got two people on the call who I think can help us.
Okay.
And we then had a conversation, and this was a Friday, and he said, okay, let me think on that over the weekend. And, through using that, I don't know, with subterfuge or whatever, to get this guy, even thinking about doing something different. And yet we managed to move forward on the basis that UMove would then manage the properties with full transparency and oversight to the lender. And 3 weeks later, we managed to get the LPA receivers cancelled, which I've yet to come across anybody who's managed to do that without actually paying the loan off. So we didn't pay them any money. We just managed to get it back, if you like, half under our control. We then had a period of 6 months of UMove managing them. And, I have to say, we managed those properties pretty effectively, fairly hands-on. At that time, we probably had a slightly more challenging tenant profile than we've got now. And after 6 months, UMove were good enough to say to Northern Rock, look, we're just adding cost here. We're not, by us managing these, actually, we're probably not managing them quite as well as they were being managed, because we're remote and we don't know the properties as well. And we're adding layers of cost in terms of, there's a management fee going in here. Obviously, repair costs. We have our own maintenance team, so they were being outsourced at an additional cost. And so, thankfully, on the approach of UMove, Northern Rock allowed us to take the management back. So 6 months later, we were sort of back where we started. But unfortunately, in that period, tenants had left, tenants had not paid. We'd incurred significantly greater costs than we normally would have done. And, we were, several tens of £1,000s backwards from where we had been 6 months before. So it certainly didn't, we got the properties back within our control. But it really, having climbed out of a hole in 2008-9, it was massively frustrating, that, quite frankly, for no real good reason.
Finding yourself back in there again.
Yeah, exactly. And then, since then, so that then takes us through to sort of 2013, and up until probably 2019 into 2020, we'd not had any capital growth or rental growth in the Northeast. So, to be honest, we'd bumped along a bit since then. But my view is, if we can keep kicking the can down the road in terms of sort of keeping lenders happy and just about keeping our head above water, the values will come back. At some point, the rents have to go up. It's just the economic cycle. You don't know when it's going to happen, but it's going to happen. So, that's sort of the the game we've been playing for the last decade, I guess.
And this is 170 properties. That was all amassed quite early on, and you've just been hanging on to all these.
Yeah.
And
So
they're all
pretty
predominantly in
much.
Sunderland.
Pretty much all bought pre-crash. We've bought one or two bits and pieces since. In terms of Sunderland's, probably, I mean, at that time, we probably had closer to 200, and we've sold bits and pieces off as we've gone along. And at that time, probably the split was probably about 120 in Sunderland. We probably had about 20 in Liverpool, a couple in London, which we've still got, and then the balance of those, whatever that is, my math is right, is about 60. What you call sort of relatively bog standard buy-to-let, single lets across the northeast. So anywhere from Sunderland up to Morpeth in Northumberland.
Sure. And, like when you're in negative equity, a lot of people talk about lease options and how they can alleviate a landlord of their responsibilities of repaying the loan. Was that ever something that you were approached for somebody else to, like, I'll take over the payments, I'll take over the stress of it all, and you just and hopefully if the values change in 5 years, we can agree to buy it off you, and if they haven't, maybe we'll just extend that for another 5 years. Was that ever offered to you? Was that ever something that was on the radar?
No, I mean we have, and we still have we have one property on a lease option ourselves. So it was something I was very aware of as a potential opportunity. But I think it was more the case that as long as we could keep paying the loans, then why would we effectively give the future capital growth to someone else? That was, if you like, that was our pot of gold at the end of the rainbow, as it were. I hadn't gone through all that. I'll moderate my language as best I can. I hadn't gone through all that situation and stress and all the rest of it just to sort of walk away with nothing. And potentially with a lease option, all you're doing is, ultimately the loan is being paid off and you're not ending up with anything. I guess there are always deals to be done where you could say, look, we'll split the upside and whatever. But my view was, if we can keep paying the loans and managing the properties, then we'll hang on for the uplift when it comes. And thankfully now, to some extent, we've certainly had some growth over the last 3 years. That's possibly taken half a step backwards over the last 6 months. And, I think at best will probably be level over the next 6 months, maybe, drift back a little bit. But, we now, where on a lot of properties we were underwater, we've now got some headroom on a fair amount of our stock, which just gives us a bit of flexibility, really.
Certainly the inflation that we've been seeing, so actually has been somewhat beneficial for somebody like yourself, because that rental income will trickle into the northeast and across the country. Inflation and rents are usually linked, and therefore you should see better yields, and then that should also have an impact in the future, in the coming months, years, on your property prices, and that'll bring your LTVs back to something that's a bit more manageable for you.
Yeah, no, absolutely. Yeah,
so
and we have.
So you've been actually a big fan of the recent inflation.
Well, yeah, yes and no, in the sense that there's two sides to that coin. So the positive side to that coin, if you like, is yes, we've seen pretty significant rental growth. Having said that, if you average it back over the last 10 years, it's as an average, it's a little bit each year. But we've seen 30% over a couple of years on some of our rents, which is great. The other side, the negative side to that coin, is of course that high inflation has led to massive increases in interest rates. So if you think, and because we've either been underwater or even more recently just sort of tight on LTV, we have refinanced some properties, but we haven't had that ability sort of across to the board to say, right, let's refinance everything and fix it at, if we were a year and a half ago, we might have been able to fix stuff at high twos, maybe low 3.1, 3.2%. But, we didn't have that flexibility. And also at that time, I suppose, highest tracker, a lot of ours is on trackers, anything between 1 and 2. So when base rate was 0.1, we were paying 1.1 or 2.1.
Very good.
If we were to refinance, even if we'd had the LTV to do that, we'd have probably been paying, say, early 3s. So it would have cost us at that time. And, we were building turnover, building rent through growth. So it was always right. Let's hang on. Let's not do that yet until we really know we've got the headroom to do it and we can afford to do it. And then, as I say, interest rates have rocketed, quite frankly, far faster than anyone envisaged. I think we were all sat there 18 months ago saying over the next 2 to 3 years, it might be 3%. What we didn't know is in 15 months, it was going to be 4.25. So if you think on our 1 and range of 1 up to 2% trackers, we were paying 1.1, 2.1. We're now paying 5.25, 6.25, which in percentage, so that's about a 200% increase in our borrowing costs, which unfortunately has accelerated faster than the rental income. The good thing is I'm hopeful that we're about there in terms of peak of interest rates. Who knows, quite frankly, inflation doesn't really seem to be heading south too quickly.
Yeah.
And the BOE have a very blunt instrument, I think, in the sense that the only tool that seems to be available to them is to keep putting interest rates up. But I think we're there or thereabouts in terms of that peak. I think rents will continue to grow. So whilst in the short term our interest costs have grown faster than our rental income, I think the growth in interest costs hopefully is pretty much tailing off, and the rental income is still growing, hopefully to sort of catch up that gap. So
absolutely,
that's where we're at.
I happen to agree with you. I think on that analysis and forecast. This episode is sponsored by the PLMD Group. PLMD Group is made up of the PLMD Development, PLMD Estate Management, and PLMD Capital, providing expertise in real estate development combined with asset management. With more than 70 build-to-rent properties and £20 million of assets under management, PLMD's extensive knowledge of local planning policies have resulted in a strong track record, turning liabilities into valuable assets. The group delivers value through a fusion of experience, innovative design, imagination, hands-on management, and sustainable resources. To find out more about PLMD and the services they offer, head to plmdgroup.co.uk. The 170 properties is a lot of properties. Is it something you do full time or takes up most of your time at least?
Yeah, in terms of running the business, it's very much full time. I do employ people. I don't sound snotty about it. I don't have direct contact with our tenants. I'm not involved in that day-to-day hands-on management. I don't do viewings, inspections, chase rents. Tenancy agreements. None of that stuff is sort of within my responsibility. I'm very much responsible for the finance end of it, which I think if things weren't so volatile, would probably take up far less of my time. But given that we've had this massive rise in interest rates, rents haven't gone up as fast. You're quite frankly, I feel more like a juggler than a property investor sometimes, I think, or a plate spinner. So, at the moment where, the finance end of it is very noisy, if you like. So I'm pretty busy doing that. I mean, having said that, I do have time to do other things. And I'm very much, looking out for sort of development type projects. Where I can add significant value at the front end. One of the things we haven't done over the years is work with investors, and that's something I'm very keen to do because certainly I've got the knowledge and the capability and hopefully the credibility to do that. And clearly there are people out there, lots of people who love to invest in property but don't have that skill set. So that's something I'm sort of actively working on at the moment to team up with people to enable us to fund those perhaps chunkier projects. Because what I don't want to do is refurb a 80 grand house to make it 120 grand.
You've been there, done that.
Yeah, exactly. And again, I don't want to be. That sounds sort of high and mighty about these things, but I think part of that property career is hopefully you move up to bigger projects.
Absolutely. And I mean, it's not that many people that can safely say that they've had anywhere near 100 properties or 100 70 or 200. In terms of the funding, which is something that you spend more time with, do you have like individual buy-to-lets on each and every single one, or do you have like a portfolio loan that covers all of them, or are they in phases and chunks? How do you go about funding that?
A bit of a mix. So the Northern Rock stuff is still with Northern Rock, and in fact those loans expire in a year's time. So we've got to refinance those over the next year, which we're given how slow the refinance market is at the moment. That's something we're on now. We've got 12 months to do it, but we're very much looking at that now. And it may be that in order to make that make sense, we've got to sell a few properties from within that portfolio loan, perhaps to reduce the LTV a bit, to get better deals on the finance. But the rest of the portfolio is we did have some portfolio lending with RBS. We've refinanced most of that over the last sort of 18 months, and all the others are on pretty normal buy-to-let type mortgages, from all the, if like, usual lenders. And most of those, despite the fact we bought them 15 years ago, still got at least another 10 years to run on them. So despite the fact that some of those lenders, and I think they're covering their own backsides, quite frankly, because they're interest-only loans, so they're almost obliged to write to you now to say, oh, how do you intend to repay this in 2032? To which the answer is, well, I'm not entirely sure at the moment, but worst case, we'll sell the property.
Yeah.
And ideally, we'll refinance it.
What yield is kind of areas like... So, the interesting thing is, I grew up in Durham.
Yeah.
And in Durham, you as a football fan, you have almost a choice of 3 football clubs that you can safely support. I mean, Darlington's up there as well, but if you want one of them in the higher league, you've got Middlesbrough, Sunderland, and Newcastle.
Yes.
I just happened to pick Newcastle because my best friend was a Newcastle United supporter, and he's taken me to those matches. I could have easily become a Sunderland supporter. And there's quite a big rivalry in the Northeast between these Newcastle and Sunderland fans. So I always had this connotation in my mind that Sunderland is, it's not the wealthiest city in the country. And also when I started doing more property investment research on where the best places and the worst places in the country are, Sunderland sometimes comes up on those records. Now, I invest as well in Kent, in Medway, and there's also Chatham was sometimes there, but I actually invest in and around that area. Do you think that, what some people say, location is really important. Do you think that some of the woes that you've had with, and then the difficulties and the challenges have been due to the location of the city itself, Sunderland being a difficult city where you haven't had a lot of capital growth, this sort of stuff, and you may have had more problematic tenants or higher voids? Or do you think that it's just the nature of the beast, and there's pros and cons to wherever you invest, and this is just one area? You've still made money off the back of it, but it's just been challenging along the way. I mean, how do you think of that? So would you do it again, is the point?
To answer that question first, yes, I don't think I'd have any hesitation in doing it again, albeit I'd sort of perhaps do it differently, and I'm happy to come back to that. I think in terms of that sort of lack of capital, I think the problem that, quite frankly, with hindsight, we created for ourselves, if I'm, hold my hands up to, is we grew, too fast. We over leveraged, so we got to 2007, and then, even those properties we bought 10 years earlier, we'd then leverage those up to the max as well. So it wasn't like, ideally what you want to do is buy a property and let inflation or, capital growth sort of take care of the debt. We were very actively growing, and to be honest, that's still the mantra for a lot of people, and I would urge caution to doing that. So I think the sort of fundamental thing we got wrong really was to over leverage and grow too fast. And also, I think alongside that, one of the things I've come to, I think relatively more recently, is the idea that actually the ideal sort of in property investment scenario is having a trading business that is generating income that can pay your day-to-day bills. And then the property investment side is all about long-term wealth building. And that trading business can be a finance brokerage such as yourself, or it could be a sourcing business or a letting agency, or it could be a completely unrelated to property.
Sure.
But having that business that is largely repeat business and recurring income, because much as when you look at a rental property on paper and you say, right, that's going to generate me X. So even a really decent HMO, say, right, it's going to make me £2,000 a month. If the boiler goes bang,
Yeah.
you're 2.5 grand. So you're then 500 quid down on the month. And if that 2 grand is supposed to be paying your bills, you're scratching around. Properties every so many years need new roofs. Even up in Sunderland, you're probably talking 6, 7, 8 grand for a new roof. So I think trying to, as I have done, generate your principal income from a rental portfolio, particularly if you're using finance and leverage, is quite challenging. So I think one of the things, if I had my time again, is I would have some sort of business, and that could even be a flip business. And okay, that's chunky money.
Some transactional business where you can actually.
So your rental portfolio can sit there. You can, if you are making a profit, you can roll that back in.
Yeah.
But you're not constantly pulling that out to live on, which is quite frankly what we were doing. Coming back to originally what you were saying about, if you like, was it because we were in Sunderland that was the root of the problem? I don't think it was. And what I would say in terms of that very limited capital growth, that's pretty much universal across the Northeast. If you looked from, say, 2007, which was probably the peak, until probably 3-4 years ago, most of the Northeast, certainly from, say, Darlington upwards, had seen little capital growth. So I guess it was a consequence of the location, but not specifically Sunderland. It wouldn't have been any different if we'd been in Darlington or Newcastle or wherever, because those areas didn't have any growth in that period as well.
Yeah, that makes sense. I think it's a classic multiple streams of income. I think if you, it's almost whatever you do, it's important to try to be diverse. At the same time, I mean, there's different schools of thought. Some people say that if you go diverse, then you don't do one thing very well. Some people say have a focus. But I do agree in general. I think rental income, to be your primary source of income, you need to have a low leverage strategy to feel comfortable and sleep at night that the banks, because otherwise the bank does practically own it, and you're just managing it on their behalf for as long as possible until they say, actually, I don't want to do this anymore.
Yeah.
And that's the risk. So having some sort of transactional business in the background, or in the forefront, I think it gives you that little bit more peace of mind that you've got things, income for a rainy day. So that all makes sense. I mean, it's a very fascinating story. There's not many people that not only have done that, but have had to go through what you've had to go through to maintain it all. And still, you're still doing it, which some people, I think, they just say, you know what, I give up, and, throw all the bad credit scores and the rest of it at me, and let me see if I can try something different. But you've persevered, and I think that's a good trait to have.
Yeah, I think that I think I do have just that never give up mentality, and I think when I look at things now, I think if it had been the case that actually the lenders pulled the plug on us in sort of 08, 09, then quite frankly we would have had no wriggle room but to go bust, and arguably starting with a clean sheet of paper at that point, I might well be in a better position now, but to me that, if you like, just throwing your hands up and walking away from stuff was just never the option. And I think, and as I say, I've given some talks about resilience, and I've looked at sort of dictionary definitions of resilience and things like that, and I don't think they quite get it. And I encapsulate it into winners find a way. And what was really rewarding, actually, I gave a talk about a month ago, and then I went to another event, and one of the people at that event had heard me talk and said, I've had some really stressful situations over the last thing, but I keep returning to Jason's winners find a way. And that was massively rewarding for me. That your own experience and talking about that and sharing that with other people can actually have a positive influence on other people. And it was a real. I
love that, winners find a way. That's a very good way of putting it, to be honest. I think
it's really simple as well. I don't, and maybe I should sort of get up every morning and have half an hour of mantras, but that was sort of something that just always popped into my head. If you're really struggling, it's just whatever's in front of you, winners find a way.
It reminded me of a book, actually, I read. I think it was Alistair Campbell. It's called Winners, I think. And it's all about people that have been incredible champions in there, and a lot of sports people that have just dominated their industry. And it is, they are just incredibly resilient. They always find a way. There's no excuses. They're fully 100% accountable for themselves. And I think that is what you need to be able to do to, one, be in business, and certainly if you want to be in property. And of recent times, you've gone more into the service accommodation short let space.
Yeah, so probably it's about 8 years ago now. It's actually sort of existed as an industry for a long, long time, but perhaps not as if you like, sort of well known or prominent as it has more recently. And it was something that sort of started to come up on the property radar. And I thought, this is something we should do. So we've taken a number of our multi-unit freehold blocks containing a total of 18 units and had those as serviced accommodation for that 8-year period. And generally it works pretty well. I think because it's about 10% of our portfolio, it perhaps doesn't always get the attention that it should do, and that's something I'm sort of actively progressing at the moment in terms of better marketing and really ramping that up. But certainly the way we sort of manage that from a KPI point of view is we look at what profit we're making over and above if we just got those on AST rents. And to be honest, there are some quiet months when we're slightly below that, but overall, we're definitely ahead of where we would be on ASTs, and that's without really pushing it as hard as, quite frankly, we should, and are now starting to. That's been really good.
What's your in terms of service accommodation? What's your tenant type? Do you typically get? Are they professionals? Are they weekend romantics, as I like to call them? Are they because Sunderland is a university town as well? Do you get parents coming in?
Mm-hmm. So I would say all of the above, to be honest. Yeah, we get a fair few contractors during the week. The Nissan factory is a little way away, but we have had we've had a gang of guys from Poland who are doing a big project at Nissan, staying for a number of months. Equally, yes, we get university parents coming to stay, particularly around graduation period, which is sort of July. We tend to get a lot of people then coming for that. People visiting family. So a whole range. People who are just happen to be working in the area for a week or two. We get actors who are coming to the theatre. So the Empire in Sunderland is physically quite a big theatre, and therefore it gets a lot of the big touring productions. I think The Lion King is still on, and we've got quite a lot of people staying. If it's not still on, it's about to be on. We've got quite a lot of people staying, for a sort of 4-week duration for The Lion King. So a real mixture.
And with service accommodation, you get the higher yields, so the better income, which is always the attraction. But it comes also with more responsibility. And it was funny, we were talking about this earlier with another guest about the regulation with buy-to-let. And how, let's say, 20, 25 years ago, you needed an AST and you maybe even needed a gas safety certificate. And that was a fairly recent thing, even in the last 20 years. But now there's a whole host of stuff, including kind of border controls, right to rent and the like. And then you've also got things such as Section 24, where you're getting taxed on your revenue. All of this stuff is being thrown at landlords such as yourself. How do you overcome all of that as well?
Yeah, so I guess, I mean, in a way, and I think it's part of the reason, not the whole reason, but part of the reason why the serviced accommodation short let stuff has come to prominence is it actually gets, I wouldn't say gets round, it more avoids a lot of those things. So you've not got right to rent checks because it's no different from a hotel. You avoid Section 24 because it doesn't apply to furnished holiday lettings, which, from a taxation point of view, is what it fits into. So, I'm not saying you can sort of fly by the seat of your pants in serviced accommodation, but it doesn't have all those regulatory things necessarily, or in the same way that AST letting has. Having said that, it is a trading business, and I think a lot of people, I see people on Facebook say, "Oh, I've got one property, the tenant's just left, I'm thinking of putting it on Airbnb," and it really, really is not as simple as that. You might have, we have a minimum of 2-night stays, so you could have 3 or 4 changeovers in a week.
Yeah.
That's not something you can realistically do with one property. Now, you might completely outsource it and get someone to manage it, and that's fine. But in terms of trying to run that yourself, I mean, we do self-manage those, but we've got 18 units and we've got a much larger portfolio, so we've got people who are managing the whole portfolio. So part of their time is dedicated to managing the serviced accommodation, the short let stuff. We outsource the linen. We use a linen company. We outsource the cleaning to a cleaning company. Okay, we tell them when they need to turn up and what needs to be done. But there are elements of it outsourced. But we've got sufficient scale, I think, both within our short let business and the wider business to justify that overhead. And I always say to people within serviced accommodation, unless you're going to have 10 units from a self-management point of view, don't bother. It's not worth the hassle, to be honest. I don't think.
Yeah, no, I happen to agree with you. And the new use class, have you heard of this?
Yes,
C5.
Yeah, absolutely. And sort of hesitate to take any credit for it, but for the last X number of years, I've been saying that I thought that if they wanted to regulate, then that was the way to do it. It's exactly what they did with the C4 HMOs. And indeed, this happened 6-7 months ago in Wales. In Wales, in fact, they now have a C5 and a C6. And I can't remember off the top of my head, there's a slight difference between them. So they're both short-let type categories.
Oh, right. They've actually got that in Wales. I didn't know that.
Yeah. As I say, I think it was October that came in Wales, and Scotland are bringing in licensing. So actually, Scotland and Wales are ahead of England in terms of the regulation of short-term lets. For a long time now, it's been regulated in London. In fact, from 1974, and I think called the Greater London General Powers Act 1974, said any let of under 90 days in London required planning permission. Now, what happened when we came around to the Olympics in 2012, which was spitting distance from where we're sat, a lot of people said, well, isn't this ridiculous? We're a major city and we can't let our properties out to people coming for the Olympics without, in theory, needing planning permission. Having said that, if someone lets their property out for 2 or 3 weeks, by the time the planning authorities catch up with that, it's long since gone. But I think it did cause the regulatory authorities to have a look at that. And so in 2015, the Deregulation Act, what they said was, okay, short lets are anything under 90 days, but you can have a number of those up to 90 days total in any one calendar year without the need for planning permission. So people talk about the 90-day rule in London. Actually, it's almost a 90-day allowance, if you like. In other words, pre-2015, you couldn't do it at all in London.
Okay.
So since 2015, you've been allowed to do 90 days. Now, that's purely in Greater London, so that regulation has been there, so for all of that time. Since then, Scotland is now becoming more regulated. Wales has become more regulated. And now in England, they've put out 2 consultation papers. One, as you say, about creating a separate use class, which is C5 for short lets. And there's debate about how that should be defined. And the other is about licensing. Now, on the planning front, what they're proposing, which, as I said, exactly the same with C4, is that when they bring the C5 use class in, and as I say, it's a consultation paper, and I think it's really important to understand, because a lot of people have jumped up and down and said, oh, you now need this, that, and the other. No, it's a consultation. They've not even published a bill yet or anything like that. But one of the proposals, and this is what they've got in Wales, is that normal residential dwelling is C3. And what they're proposing is that you can move from C3 to C5, which is short let, or will be, and back again as permitted development. So you won't need planning permission to do that normally. It's exactly the same as C3 and C4 small HMOs, which are 3 to 6 occupiers. But in areas where the council want to be able to control short lets, and quite frankly, Cornwall would be an obvious example, where there's a lot of pressure, and some city centres, the local authorities will be able to propose an Article 4 direction that removes that permitted development right to go from C3 to C5. They probably won't remove the right to come back again, and that's the same with HMOs. Again, where there are Article 4 directions, most of them stop C3 to C4, but they don't stop C4 to C3. But then once you've done that, you can't go back again. Yeah. So that's, as I say, there's multiple options in the consultation paper, but that's broadly what they've done in Wales. And I've said, people have talked about, is regulation going to come in? And I've said for some time, I thought that was a neat way of doing it. The good thing is, and again, something people seem to have sort of missed the point of, is that if you're already doing short lets, at the point when that law comes in, C5 will be your lawful use, and exactly the same as C4. And if then an Article 4 direction comes in, as long as you're doing that short let within the definition of C5, you've got what are broadly termed grandfather rights.
Yeah.
So it's not suddenly going to be the case that everybody now doing short lets is suddenly going to have to apply for planning permission because they've already secured that lawful use. What it will cap in the areas of high pressure where they bring in an Article 4 direction, it will mean that if you want to do short lets, you'll need planning permission, which obviously will control it. And I think the licensing thing is exactly the same with HMO licensing, is really, and I don't mean to diminish it, but it's a tick box exercise in the sense that, in order to get a license, you need to do the following things. It's not a case, whereas planning is subjective, local authorities say, no, in broad terms, we don't like the look of that, so we'll not allow it. With licensing, if you meet, if you meet the terms of the licensing, you will get a license exactly the same as HMO. They can't refuse an HMO license for a planning permitted HMO on the basis that they don't want it to be an HMO if you've ticked all the boxes.
And it will restrict the supply as well at some point, especially if the Article 4 does come in. So if you can get in now and you've got a few good units that are doing well, that restriction supply should hopefully guarantee your future success as well, which is, again, it goes back to what's happened with HMOs. And I think that it's definitely got legs. But I did hear as well that the 90-day rule will still remain in London. Apparently, that the proposal consultation suggests that. So I'm not sure how that will really benefit the C5 class, would benefit anybody in London.
Yes, I'm not absolutely sure how what the interrelationship with the two will be.
I haven't worked that bit out yet.
Yeah.
But it's an exciting time. I was actually not a big fan of it a few years ago. I just thought, I don't want to get into the hotel business and that sort of thing, and I don't want to worry about that somebody writes a review on my listing where there's a hair on a pillow or something. I was like, just one day to the next, I can't deal with that. But I found a way to make it work where it's very much hands off. I've got a managing agent in place, and it yields quite well. So I'm quite happy with the way that's going.
On that front, can I just make a quick point? And that is, I think that's a really smart way of doing things. What I would say to people is, if you're going to give a unit to a managing agent, then do your due diligence on them. And if I could it's not even a plug because I don't get anything out of it, but I have a very large Facebook group called the Serviced Accommodation Network UK, very active. There's about 16,000 people on there. So if you're thinking of doing this, firstly go on there and ask a few questions, but ask for recommendations of management companies, because there are some horror stories, quite frankly, of people managing but not passing the income on, and there's even, I would say, there's even worse horror stories about so-called sources within that market, particularly rent-to-rent market. On that front, be very, very careful. But if you've got a unit that you own that you want someone to manage, great idea. Make sure you do your due diligence, just as you do with any other managing agent. But it's really important. And if you go on Serviced Accommodation, ask for recommendations. Say Serviced Accommodation Network UK, or if you've come across a company, just go on there and post and say, look, I've come across this company. Has anyone got experience of working with them?
I find the Facebook groups in general very, very helpful because it's such a large community. Somebody's probably done or been through what you've just been through, or knows somebody within that local area. So yeah, if we'll probably be able to share the link as well in the show notes so that we can get more people to be part of that community.
Yeah, a lot of people have found it a really helpful resource.
I need to join it myself. I'm not on it yet, shamefully. But training. This is something that you're getting more and more involved in, and helping other people hopefully dodge some of the bullets that you've, in a Matrix style fashion, dodged. Sounds like on some occasions. I think that it's important that people get educated. What angle? Because there's a lot of trainers out there. What angle are you coming at it from, and what makes you so interested in this particular space?
Sure. So I've recently teamed up with another very experienced investor and developer, a chap called Chris Carpenter, to form Renegade Real Estate, and that is a training company that is there to help people who have some experience in property, have maybe bought a handful of properties over a few years, or even some of the people we're working with have come in from the construction side. So they've been doing projects for other people but never done them for themselves. So it's people with some experience. They're a little way on that, to use a much overused word, journey. and are looking to, I guess, go to that next level. And what we're really focused around is sort of development projects within which I would include sort of major refurbishments and commercial to residential conversions for people, really with a focus on people growing their portfolios. Now, of course, you can do those developments and then sell them on, but really from the point of view of creating investments. And I think one of the things people say is, I can't find deals. We very much focus on finding deals off market, so you're not competing with others for those deals. And also, if you're operating in that space of slightly larger developments, I know I've been to auctions, and anything that's a bit of a refurb, all the local builders are in there bidding for it because they're effectively putting their time in for nothing, and then in their own minds making a profit, and so they have no sort of margin on their cost, and they're always going to outbid property investors or even owner occupiers, who sometimes seem to pay done up open market value for stuff that needs 20 grand spent on it. You quite frankly, you don't want to be competing with those people. So by focusing on off market and focusing on those larger deals, and then so rather than doing like 5 refurbs of single lets to create a value add across those, you're maybe taking a project where you can convert, say, an office building to 5 or 6 apartments. And that also feeds in really well to the serviced accommodation side as well, because one of the big issues with serviced accommodation is a lot of apartments in blocks have leasehold restrictions where effectively you can't do short lets in them. So if you're creating your own stock, you can have whatever lease, if you want to chop them up, and you can then title split, and that helps with the funding. So you may be able to 100% fund something you've built and get all your money out, and also then operate that as serviced accommodation. So that's where we're focused in terms of helping people with all of those things, with finding the sites, how to make sites work, how to fund them, and there are multiple funding streams in terms of, obviously, there's straightforward development finance, there's SaaS funding from pensions, which is very popular at the moment. There's sort of friends and family type funding, private investors. And once you start looking, it's really quite surprising how much money there is out there.
Absolutely.
The number of people who are sat on £100,000 earning them 1.5% is shocking, quite frankly. And you can help those people to earn a much greater return. So, as I say, Chris and I are working with a group of people to help them to do that. And both Chris and I are sort of seasoned investors. We've made a lot of the mistakes, and people always say you should learn from your mistakes, but I tell you, it's a hell of a lot cheaper to learn from someone else's.
Absolutely, I couldn't agree more. And it's been fascinating to listen to some of the highs and the lows. I think you've done incredibly well, despite, and I think the longer you're in business, you're always going to have these challenges. Yeah. So you've done incredibly well to come out of it largely unscathed, still smiling, and still looking to the future.
Absolutely.
And I think that should be hopefully quite inspirational for a lot of people. But in terms of the people that you are hopefully getting on the training and this, that, and the other, this podcast is called Property People, 2 of my favorite things. To be a successful property person, what sort of traits do you think are necessary to have?
I think you've got to be relentless. I think you've got to be consistent. If you're looking for deals, it's no use, finding 3 deals on Rightmove, ringing up the agent, going to see them. It's a funnel game. It's a numbers game. To get that. You hear about people who say, "Oh, I did this great, 30% BMV deal." Sometimes they did, sometimes they didn't. But if they did, that was probably 1 in 100. They've probably had to look at 100 deals to find that sort of golden nugget. So, okay. You've got to be really consistent. I think you've got to have high integrity. I think there's something I always come back to. To me, it almost shouldn't need saying, but sadly it does, because I've seen people, appear in a blaze of glory and disappear rather rapidly, leaving a trail of debt or whatever behind them. And I think it goes back to when you're really in the proverbial, I think you've got to do the right things. Even recently, we've seen people with big development pipelines going bust, and those people were trying to borrow money off people right up until the last minute, knowing quite frankly full well where that was heading. And to me, it's just just, you have to operate with integrity. And you see things all the time with people who have a short-term attitude to business, in terms of, I can make as much money as quickly as possible, then that will be fine, and doing it in an unethical way. And it will inevitably bite you on the backside. And we can point to all sorts of examples of that, over the years. So do things right.
I spoke to a buddy of mine the other day, grew a very successful business out in the Far East. And he told me that every time I did something or made a decision purely for growth, didn't really work. Every time I did something just for value and to provide value and quality, on those occasions, every single time, the return was tenfold. And that's why everything I do now, and effectively short-term decision making doesn't really get you anywhere, but the long-term decision making really has its benefits.
Karma is real.
Karma is real. I mean, I you know what? I live by it just out of fear of anything else.
Yeah, because it will come back and bite you. But going back to sort of being a successful property investor, the other thing I always really try to impress upon people is it will go wrong. And I think there are too many. We've all been to those network meetings where someone stands up and says, "I started doing property, last year. I've now got 6 HMOs. I've got this. Nothing has ever gone wrong." And I mean, two things: either they're lying, to put it absolutely bluntly, or they haven't been in it for long enough. And I say to people that I can't tell you what it is or when it will happen. Something will go wrong. And I just think if people can take that on board, it makes it so much easier for them to cope with when it happens, because they can then say, okay. Because I think a lot of people, if something goes wrong, they think it must be me. I must have done something wrong. And I would say to people, no, it will. It will. You can be the best person in business and property and all the rest of it in the world. Something will go wrong. So if you know that, and then when it happens, you get, right, okay, I was told something would go wrong. Right, how can we deal with it? How can we move forward step by step, get over that and move on? Rather than, if you've watched all these, people and it's all shiny and fluffy and nothing ever goes wrong. As I say, you think, oh, it must be me. This business obviously isn't for me. Throw my hands up, walk away. No, it will go wrong.
And I like what you're saying earlier as well. It's an element of, I think for me anyway, being stoic, but also thinking a bit short term. So it's in moments of stress for me, I've been able to meditate or just live in that present moment. And you can't worry about the past; it's already happened, and you can only think so much about the future, because at the end of the day, it's out of your control anyway. But that present moment, being present and thinking about making short-term decisions while you're going through that hardship, hopefully, if you make the right decisions along the way, you'll come out largely unscathed, and move on to better, bigger and better opportunities going forward. It's been a real pleasure speaking with you today, Jason. It's a weird and wonderful world property is, and getting to meet people like yourself who've got a huge breadth of knowledge, and also out there hopefully helping the next generation of property investors bring more affordable homes, quality homes, making returns for investors. I hope it all goes well for you, and hopefully we'll get both you and Chris back in 6-12 months' time, see how some of the deals are going, how some of the students are operating, and we have a catch up.
Yeah, no, that'd be brilliant. It's been really enjoyable, and I get an awful lot of pleasure from being honest about what I've been through, because and I sometimes think it's a bit weird that it inspires people, but it certainly seems to. So if my mistakes and being honest and open about them can help other people, then that's just fantastic as far as I'm concerned. And I think on the training side, I've done a little bit of stuff before, particularly around serviced accommodation, and we've held some events. And in some ways, it's a world I've sort of been very hesitant to step into, because it is quite noisy, and there are a lot of shouty people, shall I say, within that environment. But one of the things, to be honest, chatting to Chris keeps saying to me, look, he said, there's so many people out there who've been doing this for 5 minutes and then are the latest, greatest trainer on this, that, and the other. And he said, if you and I, with, heading towards 50 years combined experience, can't deliver, training that is at the very, very least of equal value to the noisy people, then it's a bad job, and hopefully we can really, really help others to grow their property businesses in a sustainable and secure way.
And for those people to get your help, what's the best way for them to find you?
Probably just connect with me on social media. So Jason Living on Facebook, I'm pretty prominent there. Same on LinkedIn. Yeah, those are the two. I suppose I'm sort of reasonably prominent on those two. I'm not a great social media person who's all over TikTok and Instagram and whatever, but I'm very sort of easily found on those. So please do connect, and if I can help you, I will.
Thank you ever so much for joining us. Have a great day.
Thank you.
That's it.
Good.
Yeah.
All right.